What's up, everybody? Bryce here, coming at you with a quick market update. And the big story today is the Federal Open Market Committee, the FOMC, better known as basically just the Fed, right? They're meeting today to discuss some very important topics on how they're going to be, continuing their monetary policy. And so what is monetary policy? That's like the quantitative easing or the quantitative tightening. That's interest rates. That's another tool that a monetary policy tool that the central bank has at their disposal. And so the big discussion that's going to be happening tomorrow at the Federal Open Market Committee is the question surrounding inflation and the question surrounding employment. And so in the Federal Reserve, right, they've got two mandates. And one is to keep inflation low. That's one mandate. The second mandate that they have is to keep employment high, right? And so we're actually in a kind of a weird scenario right now where it's kind of similar to the 70s when you had stagflation, where you're having really, really high, abnormally high inflation because of how much money has been printed and the economy is really starting to pick back up. So we have got abnormally high inflation. CPI calls it about 5%. Some other sorts of metrics have it pegged higher than even 12%. But you also have really high levels of unemployment. And it's kind of funny, right? You think, oh, well, the economy's picking back up. Why are there such low levels of employment right now? The reason why, unemployment is still high is due to the fact that there has been so many government subsidies, right? And, for better or for worse, people are, continuing to take the government subsidies, even though the economy has started to open back up. So there's a little bit of a lag time where people are still taking their government subsidies, still not working. But eventually, there's a labor shortage now, but eventually people are going to have to work, right? You can't just live off of government money forever. And so, at least that's what I believe. I mean, there might be a few beliefs there, but I think that at the end of the day, what's going to happen here at this Federal Open Market Committee meeting is that the market's waiting for two things. They're waiting to either hear the Fed say, we're going to start tapering rates, meaning we're going to start bringing rates up, which means money gets more expensive because the cost of borrowing gets more expensive if you bring the rates up. So typically in those sorts of environments, risk assets or equities or even crypto, they start to fall. But the key thing here is this word called transitory. Is inflation transitory? Whereas the Fed is saying, well, we have high inflation right now, and it's passing. It'll leave. And then there's kind of the other side of the camp that says, well, no. It's not just going to go away. Inflation doesn't just go away overnight. This is a systemic issue that has been caused by all this money printing and by all of these government subsidies and by having employment levels, at extremely, extremely low levels, right? Low levels of full employment. So it's just been a really, really, really wild scenario. And all of that kind of comes to a head tomorrow. So that's why we're talking about it on this market update, is because what happens when the Federal Reserve members of the Federal Open Market Committee, when they come together and they determine and they signal to the market what they're going to be doing? Are they going to continue buying, U.S. government bonds and flushing liquidity into the ecosystem? Or are they going to start to wean us off the teat and taper rates? So who really knows? But how I'm playing it in context of crypto is if they signal that inflation, is transitory and what they're doing here is, they're going to keep QE. They're not going to bring rates up and they're just going to keep rates cheap. If they kind of signal that, that's a long trade on crypto, right? I go long, because that means crypto as an inflation hedge will perform really well in that sort of environment that the Federal Reserve is sort of enabling. However, on the opposite side, if they say, we're going to start bringing rates up and they get really aggressive, really hawkish, that's not great, right? That's not great for crypto. That's not great for equities. I'll be looking to be a little bit more protective. And so that's kind of how I'm thinking about it. That's how I'm playing it. In our model portfolio, we've got several fundamentally strong cryptocurrencies And I think they're all going to be affected by this sort of announcement that's happening later today. So if you guys aren't already subscribed to our service, where we've got, fundamentally strong cryptos that I think are actually, going to really withstand the test of time, especially these short-term sorts of volatility, you need to check out our model portfolio. And it's, again, we're doing a $1 trial to subscribe. So click the orange button and check us out. And so, guys, that's the market update. Strap in and strap on, man, because it's going to be a really, really wild week. But I'm excited. I'm cautiously optimistic. And without further ado, I'll see you tomorrow for another market update.